The risk of loss in trading futures and options can be substantial. Therefore, only genuine risk funds should be used in such trading. Futures and options may not be a suitable investment for all individuals, and individuals should carefully consider their financial condition in deciding whether to trade. Option traders should be aware that the exercise of a long option will result in a futures position. Information herein has been obtained and prepared from sources believed to be reliable. Comments contained in these materials are not intended to be solicitation to buy or sell any of the commodities mentioned. Past performance is not indicative of any future performance. Opinions expressed here are the opinions of the author only, and not the opinion of any firm the author may be affiliated or associated with.
All right, welcome back to Commodity Classics. I'm Michael Yorba, your host. My guest this segment is Ty Andros of TraderView and TedBits. Let's bring him on right away. We've got a lot of ground to cover in a short amount of time. Ty, thanks for showing up, buddy. How you doing?
Thank you. Thank you for having me.
Oh, my pleasure. All right, I had a chance to go through your newsletter a little bit, and I just wanted to see if I can ask you a few questions. On the second page of your newsletter, you're talking about we're in the early stages of a gigantic crack-up boom. That was a very successful newsletter you wrote, or articles, series of articles about that. Are you going to cover more about the crack-up boom in future articles?
Yes, the crack-up boom series is starting again. Actually today or tomorrow, and it should run through the summer. Okay. Because of what's going on in the banking systems and the financial systems of the G7, they just have got to print more money than you can imagine.
Well, and what does that mean? What's crack-up boom mean? I mean, in a nutshell.
Well, crack-up boom is where inflation becomes a policy of government.
Okay.
And it's really where all financial and banking systems go to die. They started all the way back in, 694 BC with Ceylon. And it's crack-up booms really, are the end game of empire.
Okay.
And in this case, it's the G7. And their financial systems are rotten to the core from years and years of overprinting of money and overstimulation and negative interest rates, and so malinvestments are collapsing along with their financial industry's balance sheets, and so to save those balance sheets, they've got to print more money and steal the money out of your viewers' bank accounts.
Kind of like the alligator trade. No matter how many times you try and get out of it, you got to put on more trades to fix it, and it ends up eating you alive anyway.
That's correct.
Later on in the newsletter, it says the thrill ride. It's a 4-part edition. What's the thrill ride about?
Well, the thrill ride is about we're on the backside of the last what I'll call reflation. The reflation started in 2001 and 2002 with Alan Greenspan, and he just printed his way out of what he thought was a deflationary prelude, and we had the concomitant run up in the economy. But it was really kind of not based upon anything other than overstimulation of the economy. And we saw the peak of that about now a year ago, or a year and a half ago. And we're now in a period of rapid wealth destruction and plummeting incomes. And plummeting from a number of different ways, whether it be plummeting income tax receipts by the federal government or the state government, or the loss of income by your viewers by inflation.
Okay.
When inflation's running at 11% and they got a 3% raise, well, they're 7% poorer this year than they were last year.
Right. Now, I've got a real quick one for you. If all the financials die, how do we trade? Do you think it'll ever get that far?
Say that again?
If all of the financials die, how do we trade? That's a question that showed up on the shout box. But
the financials are not going to die.
Right. I was just going to.
You already know that because they stay bear stearns. That was their line in the sand. They socialized the risk at that point.
Okay. All right, good answer. Let's bring up that first chart. It's the Wolf chart. It's the S&P earnings per share 3-year average. It says the collapse in income from the Wolf wave is biting, and I think you're.
Well, that is that was what I called the chart of the year.
Right.
During Thrill Ride, and even though you can see it's not through the bottom part of that megaphone, if you put in the first quarter, it has now gone through the bottom part of that megaphone.
Oh, boy.
Okay, and that's collapsing corporate earnings. Year over year, S&P earnings are down 25%. If you take out the oil sector, they're down over 30. And, that's not going to end anytime soon. It's going to go a lot farther. I really don't believe they'll can turn it anywhere earlier than early next year.
Okay. I got a couple of real quick questions off the shout box I want to get out to you, all right?
Sure.
You're really causing people to think. Do you watch cycles on the U.S. dollar? I think we saw a U.S. dollar cycle bottom and U.S. dollar, and will the U.S. dollar rise?
It may rise temporarily because the long end of the curve is really kind of breaking down out of a bear flag. So there's some, there's some support there, but no, actually, I believe the dollar's in for a slow, cruel death. Actually, there's another chart we're going to bring up here during this section that's going to kind of show you that the sentiment's really ready for the dollar to turn back down here.
Okay. Real quick, and then let's bring that other chart up, the dollar chart. And Aussie Pete is one of our viewers from Australia that gets up early to watch our show. He says, leaving the Fed funds rate at 1% for 3 years after September 11th, when the economy recovered 2 months later. Do you feel that if we have some big problems with the stock market, we'll be doing the same thing?
I don't expect the interest rates to go higher for over a year to a year and a half.
Okay. Did you want to go to that dollar chart?
Sure.
Okay, let's bring that up. All right, what are you telling us here on the chart, Ty?
Well, it just basically shows sentiment. This is by a good friend of mine, John Kosar at Asbury Research, and it really shows extremes in sentiment using different Ridex funds.
Okay.
And as you can see, the sentiment is in a least bearish position right now. So a lot of people have gotten generally friendly to the dollar, just like your Squawk Box guy, and they're really in there, I think, for a little surprise.
Okay, so tell me, just is it a technical or fundamental thing that you're looking at that gives you the conviction that you're coming out with here that we're going to drop in the dollar, that we're not done devaluing the U.S. dollar?
Well, we're not done devaluing the U.S. dollar. It's an endless process right now. They have to print the money.
Okay.
Either that or we're going to have a deflationary depression. And I promise you, they're not going to choose that.
Well, then, on that note, I've got another question that just dovetails that statement you just made. When will the Fed be accountable?
Not till this is all over. And that's years.
Okay. So not for a long time. They're going to be able to blow smoke for quite a while longer.
Understand, the Fed is, the only master the Fed has is Wall Street and the New York banks.
Okay. All right, that sounds good. Now you got this other chart in here, XLB. Let's bring that up and just give you a chance. We've got 5 more minutes in the segment. There's no rush. We can go over and talk freely about a bunch of stuff, but I wanted to bring that chart out.
Well, I believe actually that the period between now and last March has been more of a corrective period, and that we're about to enter the next leg. And that leg, both in commodities and the dollar and gold and materials, really started last August.
Right.
And went through the first week of March. And as you can see, the materials sector went through a very large period of correction there. And this is another chart by Asbury Research. And that really is pointing to about a 20% rise in the cost of raw materials. That's the raw materials sector.
Okay.
So you can really expect the CRB and the broad basket of commodities to generally mirror that. I really think we're on the verge of a big move.
All right, so
I think that the other shoe is going to start dropping here, starting sometime in the next 30 to 40 days.
Okay. So give me your. So do you feel when you say the other shoe is going to drop, is that going to cause a really bad downward move in the stock indexes?
No, but it's going to cause a big downward move in the purchasing power of dollars. And so stock indexes, I'm a very big bear, and the stocks are really moving down if you measure them in crude oil or gold. I mean, they've lost 75% of their value since the lows, or since the highs in 2000. I mean, it's just nominal new highs you're seeing, or we're up near the highs nominally. Measured in real purchasing power, you've lost 75% of your investment since 2000.
I got a question for you on the shout box, and it's kind of an interesting one. You might be able to answer this and talk to it. Do you think Michigan's departure from the Fed is the first sign of a collapse of the Federal Reserve?
I don't think the Federal Reserve will collapse, but I believe that people are leaving before they really get nailed for the shenanigans.
Before they're held accountable?
Well, they'll never be held accountable. I mean, they're really down to 4 voting governors, and it's just a symptom of gridlock in Washington. They won't approve or let anybody back onto the Fed. Okay, so there's not even enough people there to form a quorum. It's disgraceful, and it's the absolute. Congress is immoral in every respect. So I can't say anything. When the approval ratings are 18%, most of the country understands that they don't work for the public; they work for their special interests.
Right. All right. Let's get to that CPI chart. And I got to admit, ever since they took gasoline or food and fuel out of the CPI index, I've just kind of blown it off as like this is for this is for journalists. It's not for traders. So let's bring that chart up, and you can talk to it and tell me about what your thoughts are on this.
Well, that's by John Williams at Shadow Stats, and John is an presidential economist. Worked in the Bureau of I don't know where he worked, but he was a government economist. And what he's done is he has undone the statistical massaging that they've introduced over the last 20 years. So this is basically how inflation was measured during the early part of Reagan's term. So as you can see, if you were comparing apples to apples in Reagan's term, if you recall, the height was, 14 or 15. I think you can see it there on that chart. Mm-hmm. We're screaming along. There's a rapid inflation going on, and of course anybody that has to pay anything for anything knows that's true.
All right, let's come back to time. Okay, thanks, Don. Well, in my opinion, from what I've heard from you, is that we're looking at higher rates, far faster and stronger than most people believe, and higher rates of inflation to the point, would you even attempt to call it true hyperinflation as we go forward?
Hyperinflation is a fairly inflammatory term, but I do believe that we're going to have increasing inflation. I believe they've printed about $1 trillion since last August in one way or another, and that's money that you can put your finger on. I'm sure they're slipping it into the system in other ways, and I believe that they're going to print another $1 trillion probably between now and Christmas.
Wow. All right, this newsletter of yours, how do people get it, and then how much is it?
It doesn't cost a dime. It's called Tidbits. It's free by going to my website and signing up. It's fairly widely distributed, as you well know. It's on Financial Sense and Market Oracle, Safe Haven, dozens of sites. It's widely read. But it's we call it the Economic and Financial No Spin Zone. And I pride myself in, ripping illusions away.
All right. All right. Thank you so much, Ty. I really appreciate you coming on. Ladies and gentlemen, it's very, very thought-provoking reading. Ty, we'll talk to you later.
www.traderview.com.
Okay, we'll get it out there for you. Thanks.
Thank you.
You're welcome. All right, that was Ty Andros, Trader View. We'll be right back after these messages, and we're going to get right into that FX fund that I was telling you about, ladies and gentlemen. I set up a $5 million fund just so you could see how it really would work. I'll be right back after these messages.